Thank you very much, guys. Oops, I got messy. Let me just go back to one slide of Urbans. I'm going to talk about why value investing works, but also sometimes doesn't work. And that, of course, focuses on the last 8 years where we have gone sideways as opposed to up, which is what we'd like to be doing. And the question to some extent is, why is that? And is it all because you're not very good at what you do? And that's part of it. But the other part of it is the environment has been terrible. And I wanted to go back into history and take a look at what we can learn about that. So I'll cover 3 topics. It's one, show you how value returns look over time, then talk a little bit about why it works, how it works, the value investing style, and then finally say something about the outlook. Okay, so this is the chart that essentially has kept us in business all these years. It takes the data that Fama and French first started in their created in their seminal paper, and it's now available on Ken French's website at Dartmouth. What Fama and French did was they took all US stocks and they divided them into small half and a big half. And then of those 2 halves, they built 3 portfolios. So expensive, middle, and cheap stocks. So you have 6 portfolios measured on some measure of value. In this case, it's price to cash flow. And that data goes back to 1951. Price to book data goes back to 1926 or 27. Okay, so I'm showing you, of those portfolios, those 6 portfolios, I'll show you 3. The 2 value portfolios, the blue one is small cap value and the green one is large cap value. And you see already, and then the orange line is the market, so that's not one of those 6 portfolios, that's all of them. And then the bottom line is the stocks that have done best in the last years. It's large cap growth stocks. So the big expensive names, the household names. And there's a couple of takeaways from this chart. Number one, well, no, maybe the first one is value outperforms over long periods of time. Another issue is Another thing is the small cap premium is very evident. You've made a lot more money. If you invested $100, and you fell. If you invested $100 in 1951, you made an enormous amount more just by being in small caps. And that's why we are very much focused on small caps at BWM. Then another takeaway is that large cap value, which has outperformed in the last years very dramatically, you can't really see that from this chart unless you look really, really carefully. So it's a historical anomaly, what we've been seeing, and I think logic dictates that we go back to normality at some point in the future. Okay, let's take a look at value returns over time. Number one, if you bought value when value was really cheap, you did better than if you bought value when value was expensive. We took all stocks and we sorted them into 5 groups. We took all historical periods, and sorted them into 5 groups. When was value cheapest relative to growth, and when was it most expensive? I'll show you the 2 extreme groups. On the left is when value was cheapest, and then you see the forward returns over 4 time periods. And of course, when value is cheapest, it's best to own value going forward, no matter what your time period. But even if you bought value when value was relatively expensive versus growth, even then, if you're a long-term investor, which means 5 years or more in this case, you still made money. And that's important to know. So as long as you're a long-term investor, you're not trying to make a quick buck, you should be fine with value investing over time. What if you're worried about inflation? Here's some data on how value and growth have performed in various inflationary periods. Again, we've built 5 groups. We took each year and sorted it into how much inflation was obtained at the time. The period that's terrible for value is the one we just came out of, when inflation is really low. you see there that growth outperformed. Growth in this case would be the two blue bars, small cap, the darker blue bar, and the lighter blue bar, large cap. Not a good period, but anytime that inflation is in a normal range, value is clearly better. So the gold and the green bars are better than the blue bars. And again, you see the small cap premium very clearly. And then the nice thing is, if inflation is really high, value investing at least helps you preserve your capital, make a little bit of money in real terms. We'll take a look at that here. It takes that inflationary period from the late 60s to 1981, the most famous one, I suppose. We're just showing you the two value portfolios here. In green, the small ones, and in gold, the large value. And in blue, you see the CPI index as an index. And you see how value, after a while, outperforms massively, which means you made money in real terms. That was not the case if you owned the broad market. Another issue, of course, is that all of this outperformance comes at a price, which is some periods which can be quite long of underperformance. Even before the most recent period of underperformance, which has been exceptionally long, you've had 2-year phases every once in a while where value underperformed. And we show you that with this chart. It's the relative performance of all value versus all growth stocks, again using the French data. And we show you in a green bar every period where the drawdown on the value portfolio was more than 10%. So when you did it worse with value. And you see people's patience has always been tested over time. Time and again, it happens that value underperforms. What's exceptional is the period that we just came out of. But of course, that's also been a crazy period in terms of interest rates. How do value returns versus growth look month to month? Kind of random. The chart on the left shows you the monthly out or underperformance of a value versus a growth portfolio. You see it just goes up and down. That's why I've allowed myself to give you this little chart that's kind of unreadable. There are two things that we can read out of it, though, there's one important fact that comes out of it. It's that there are periods when value and growth have very large divergences in performance. So in other words, in the 1970s, here, we had some really terrible months for value investors, but we had a whole bunch of good ones as well. Remember that this was a period when value actually did quite well. Same thing when the tech bubble burst around the year 2000, you had some awful months. And then you had some really great ones to follow. What's interesting about the most recent period with interest rates at zero is that not a lot is visible on this chart. From the naked eye, you don't see much at all. But of course, there were a couple of really bad months that just not visible in the Fama French data. I'll get to that in a second. What you need to know, though, is that over time, even though you don't see it from this chart, over time, value outperforms growth by a little bit on average each month. It's about a difference of 0.5% monthly, which, of course, if you annualize it, works out to the 3.5% performance advantage that value has over growth over time. So let's look at recent periods. Here I have to take Russell data because Fama French isn't that quick, or French isn't that quick in updating his website. And I've put in the small cap premium in the sense that I took, as my long portfolio value, I took small cap value. It would be the Russell 2000 value index. So that's the smaller stocks in there. And I've compared it against the Russell 1000 growth, so the 1,000 bigger stocks. And you see that recently it has been no fun at all. Here, COVID hit, and this was in the last 2 months. We've had some really nasty drawdowns. If you take the European small cap stocks, it's even more dramatic, and compare them against the large cap growth in America. We've had May was the second worst month ever. The worst being March of 2020, when COVID hit. Okay, I'm going to still say that value works. And why is that? if you look at returns on a stock, you can disaggregate them into 3 bits. One is that a stock goes up in value, so it changes its valuation, then it grows, and it'll give you dividends. And if you're comparing portfolios, there's a 4th factor, which is rebalancing, which means that if, for example, you buy a cheap stock and you compare it to a growth portfolio, well, you'll sell that stock as it gets more expensive and you buy a new cheap one. That's called rebalancing. And now GMO did this analysis for 2 periods. One was 1983 to 2006, and you see that value beat growth by 5.5%, and with, as you would expect, growth being a drag on performance. Value stocks don't grow as much as growth stocks, almost by definition, but the change in valuation, the higher dividend payouts of value stocks, and mostly the rebalancing factor all allow you to outperform over time. So GMO's premise was that if value doesn't work anymore, we ought to see that this relationship somehow falls apart. And here's what happens to the relationship. It looks exactly the same, except for valuation. And what this tells us is that people have no longer been willing to buy cheap stocks and then hold them until people aren't buying enough cheap stocks that they go up in value, that they go up in price. They're being ignored. People don't pay attention to valuations right now, or they haven't been. I think they're going to start too soon, or it seems like they have until AI hit a few months ago. So, putting aside the valuation factor, it's fair to say that value still works very well. Now we just need to see that people start paying attention to valuations again. I think they will. The long-term experience, as we saw in the first chart, is that they do. But of course, markets can be irrational in the short term. The metaphor for that was Ben Graham's Mr. Market, the manic depressive who gives you a bid and an ask price every day. He's never offended if you don't trade with him, but he sets the price. And sometimes he's optimistic, sometimes he's pessimistic. And that's because he's irrational in the short term. In the meantime, behavioral sciences or behavioral economics has given us a whole bunch of terms to explain this. All the psychological biases that you can read about in the literature, such as extrapolating from the past, herding, and over-optimism. Stuff that you can see happening right now with NVIDIA and anything associated with AI directly. In doing so, Mr. Market will ignore valuations. He loves momentum. You always look great if you own a stock that's just been going up. And then, of course, you have another factor, which is that professional investors are subject to career risk. For a lot of us, what matters is what your boss says at the end of the year and not whether or not you own something that's fundamentally good. Nevertheless, over the long run, most shares do reach their intrinsic values or trade near their intrinsic values. There's enough investors out there to buy them, and then if not them, then maybe private equity will come in or a competitor and do an acquisition. So over time, these undervaluations are corrected. So what's the basis for value to work is that the market is efficient, but in the weak form. The weak theory of market efficiency best explains what's behind value investing. Now, here's a couple of examples of periods when we had speculative blow-offs. Most of you will be familiar with these when the market was subject to herding and over-optimism. Again, we've borrowed these charts from GMO. What's important then for a value investor isn't so much to pay attention to what the other guy's stock price is doing in the short term and what your own stock prices are doing in the short term. What matters is if your portfolio is creating value. And for this, creating value in a fundamental sense, because ultimately you're owners of companies if you're a shareholder. People forget that. as Marcus will show you, we look at the way what we do exactly in that way. We look at ourselves as owners of the company, and so what matters to us over time is that the company actually is generating value. And one way to measure that is a very primitive way that Warren Buffett proposed. You just take the increase in the book value per share over time, and you add the dividend that you get. And that gives you a measure of creation of value by the firm itself. And as an example, I take Andritz, which is one of our portfolio companies. It's a very boring manufacturer of capital goods from Austria. And it's created value worth 19% per annum since we bought it in July of 2019, which is pretty good. Oh, it's very good. Now, what happened to the stock price? Well, the stock price, as it should, essentially followed that, but not quite. And in fact, you can see the last couple of weeks have been awful. So Andritz stock is compounding at 17.4% per annum, which means that it's actually gotten a little bit cheaper. And of course, that's not what we want. As value investors, we hope that they will get more expensive, not just create value. Let's put the two pieces together and look at the entire portfolio in our funds. On the x-axis, you see the value creation as I just described it, and you see that most of our companies have created value. The average is probably around 10%. The winners that we've sold in the meantime are not on this chart. They would make us change the axes. And then on the y-axis is the total return. So Andritz has got a red ball around it. And you see that even though, and then you have the diagonal line, right? And that's if a company's creating as much value, or if its share price performance is the same as its value creation, then it should be at exactly on that diagonal line. And as a value investor, what you want is you both want companies that are here on the right, so creating value, but you want them to be above the line. That means they're getting less cheap. They're getting closer and closer to their intrinsic value. And some of our companies are doing that nicely, but a lot of them aren't. So the market is not reflecting this value creation, and that just says to us, be patient. It will over time. You've got stocks that are doing okay. Fundamentally, they're just not doing well at the stock market, but that'll change. And then, of course, here you've got the inevitable losers. All of us buy stuff that doesn't work out, where it doesn't meet expectations. That's unfortunately part of what we do. Let me skip this chart because I think I'm running out of time and go right to this one, which is where we stand now in terms of valuation. I've taken 4 indices, 2 for the United States, 2 for Europe. On the left, the United States, the MSCI Growth Index is in blue, and the Value Index is in that greenish gold. Same thing for Europe on the right. And what we see is how a gap has opened up between growth and value on both sides of the Atlantic, right? That's very noticeable. Now, growth on both sides of the Atlantic is very expensive relative to where it normally traded in terms of price-earnings ratio. And value in the United States is okay. It's not super cheap. It's not super expensive. It's okay. You'll do fine. But value in Europe is really cheap. And that's very depressing because we own a huge amount of European, our portfolio is heavily weighted to European value stocks. It means we've been on, the performance has been terrible, but it's really encouraging because going forward, you know that this will correct at some point, so you own the right things. Right, so 2 sides of the same coin. And that brings us to the last point. How has the fund performed under these various situations? And here I'm taking essentially that second slide I showed you, that when value is cheap, it tends to do better. And I'm applying it to our own fund. So the same logic applies. Here, the solid line is the intrinsic values as we estimate them, and that does rise over time, which means as analysts, we're doing our jobs. We should be doing them better because the line should be rising more, but it's the best we've done so far. And then here you get the net asset value of the fund, and these balls at each point say what the relative degree of undervaluation is. So in a sense, you're measuring the distance between these 2 lines by the color of this ball. And the price to value right now is at under 55%, and the historical experience of the fund has been that when you're at this level of undervaluation, and this is going to apply to everyone who invests in the value style, it's not just for us, performance going forward is really good. I'm not promising it, but I really think the historical data confirms that, at least in our case, every time you were this cheap, 5 years later, you had beaten the market all the time, and over 90% of the time, you made money in absolute terms. And even in a shorter time period, you had a 70 to 75% chance of beating the market and making money in absolute terms. So what I'm basically saying is these charts show us that performance going forward for anybody who's invested in European value ought to be quite good. I thank you very much for your attention. Here's some more opportunities to hear the same thing from us in the near future. We always tell you the same story, but I guess that's part of our stock and trade. We haven't really changed our style in 25 years. For good or for ill, we keep doing the same old thing. And here you can hear us talk about it next time you want. By the way, all of these slides go online. And we can also send them to you, so you needn't take pictures unless we can send you the images too. Thank you very much for your attention. Let me hand over to Marcos. Yeah, har ni något hit? One question. I have time for one question, I've been told. Oh, and by the way, here's the disclaimer that tells you that everything I just said is a lie. Are there any questions, please? Yes. Hinter Ihnen. Please wait for the microphone.
First question is German or English? English, okay. I have one question. You showed in an early slide that we have a very long period where value is underperforming growth. And this is a much longer period than it was in the past. What do you think is the factor that central banks are buying stocks or have been buying stocks all over the globe, and they buying it passively in indexes? And we know that if you buy passive an index, normally the most expensive stocks are with the highest weight in an index. So what do you think is the factor of that they are buying the expensive stocks massively over this passive investing style?
Yes, I think anytime, everyone's buying passive vehicles. So that's one of the reasons that expensive stocks that have been doing so well is that you have more and more money going into there, not just from everybody. But I think the main variable has really been the interest rates. They've been exceptionally low. We're now in an interest rate regime which is normal. They're a little bit on the lower side historically than where they have been before, but basically we're back to where we should be. So money costs something again, and I think that's what's going to focus people's minds on valuations again. And as soon as this interest rate regime has become established and the markets digested it and the banking systems digested it, I think you'll see everyone basically calming down, and then I think value investing will go back to working.
Thanks a lot. I mean, you will have further chances to ask questions on the podium discussion. George, thanks a lot.
Thank you.
Marcus?